Here's a question, maybe a provocative one.
Hmm.
Is Japan's economic situation, a sign of bigger trouble for the whole world economy?
It's definitely a question the sources we looked at are starting to explore pretty seriously. Japan's a major player, right?
Absolutely huge.
Yeah.
Deeply connected everywhere. So yeah, when things shift there, you feel it globally.
That's the core idea. This isn't just some isolated story happening far away. What goes on in Japan, it's tangled up with global finance, markets, even your own financial planning.
Right. So for this deep dive, we've gone through a bunch of material, articles, videos, really trying to get a handle on Japan's economic weak spots, the potential global impact, and what strategies people are talking about to navigate all this uncertainty.
Yeah, and our goal here is to kind of sift through all that, pull out the key points based only on these sources, and help you understand what seems to be happening, how it links to the bigger picture, and maybe some practical things you could think about for your own finances without, sounding the alarm bells too loudly. It's really about being informed, feeling a bit more prepared.
Okay, let's get into it then. Japan's economic journey. It's quite a story. Starts with that incredible post-war boom.
Right, yeah, the economic miracle, truly amazing growth and rebuilding. But then came the 90s, and things stalled. They entered what people call the lost decades.
Lost decades. So long period of stagnation and prices actually falling. Deflation.
Exactly, deflation. And the Bank of Japan, the BOJ, their response was pretty dramatic, according to the sources.
How so? What did they do?
Well, they went all in on low interest rates, pushed them down again and again, basically kept them near zero for, years and years. We saw a chart showing just how flat those rates were.
Wow, near zero for that long.
And on top of that, massive quantitative easing. Printing money to buy up government bonds. Huge amounts.
So decades of trying desperately to pump up the economy, boost prices, boost demand.
A really sustained effort. Now, it's interesting. One source we looked at from the Austrian school perspective had a kind of different take on that whole deflation period.
Oh, what did they argue?
They suggested maybe that deflation wasn't automatically bad. It could have been, driven by good things like productivity gains. And maybe the official fear of falling prices. One source used this great term, apoplecthorismosphobia.
Okay.
Right? Maybe that fear and all the efforts to artificially push prices and money supply up actually made the stagnation worse or last longer.
That's a really different perspective from the usual story. Interesting. Okay, so that's the backdrop, the policy history. What about the situation now? What are the current challenges highlighted in the sources?
Okay, so several big ones seem to be hitting at once. First, the debt. Japan's government debt is just enormous.
How big are we talking?
Highest debt to GDP ratio in the developed world. Over 260%, the sources say. And it's still climbing.
260%. Wow, that number definitely grabs your attention. Much higher than, say, the U.S. or Europe.
It really is. And then you have the demographics. Japan is the oldest country in the world. Something like 30% of the population is over 65.
30%?
Yeah, and the birth rate's been below replacement level for decades. The actual population started shrinking back in 2008. Projections show they could lose like 20 million people by 2050.
Losing 20 million people, what does that do to an economy? Fewer workers, fewer consumers.
Exactly. Fewer workers means less growth potential, probably lower tax revenues down the line, but higher costs, right, for healthcare, pensions, for all those older people. It puts this huge structural squeeze on everything.
Okay, massive debt, tough demographics. And what about the Bank of Japan? After all those years of easy money, are they changing course?
Seems like it. The sources indicate that after all this time, the BOJ is starting to signal, maybe moving away from those negative interest rates, maybe scaling back the bond buying, started to tighten things up a bit.
Okay, but wait. Are they talking about tightening policy just as inflation is starting to pick up?
That's the tricky part. Yeah, inflation has been creeping up. Sources mentioned it hitting levels near 4% recently.
Yeah.
So the BOJ is kind of caught, right? How do you tighten to fight inflation when you've got this mountain of debt that needs low rates to stay affordable?
Right. That's a serious dilemma. So you've got the debt, the aging population, this awkward policy moment with inflation. What specific signs are the sources pointing to that suggest things might be getting, shaky?
The bond market is definitely flashing some warning signs. Japanese government bonds, JGBs, their value has been falling. And those long-term interest rates, the ones they held near zero for so long, they're climbing. We saw numbers like 30-year JGBs over 3%. The 40-year rate hit an all-time high, around 3.6% for Japan. That's a really big move.
A huge change from what they're used to.
Massive change. And sources also talked about failed bond auctions.
What does that mean, failed auctions?
It means the government tries to sell its bonds, its JGBs, and investors don't buy them. Or not enough investors bid at the offered interest rate, so the government has to offer higher rates to attract buyers.
Which suggests investors are becoming hesitant.
Yeah, it signals fading confidence, or at least a demand for higher compensation for the risk. They're not willing to hold Japanese debt at those super low yields anymore.
And why not? Why the hesitation now?
Well, mainly because even though the yields are higher than they were, they're still pretty low compared to what investors can get elsewhere, like in the US or Europe. Especially when you factor in the perceived risks around Japan's debt load.
Okay, so let me try to piece this together from the sources. You have this huge debt, needed because of the demographic drag and slow growth. That debt only worked because interest rates were kept near zero. But now, the market is pushing those rates up, partly because the BOJ is trying to step back, and investors want better returns elsewhere. It sounds like the foundation of cheap money is cracking.
That sums up the narrative from the sources pretty well.
Yeah.
The sort of artificial environment that made the debt seem manageable might be ending. The market's starting to ask, what's this debt really worth?
Okay, and this is where it really starts to matter for everyone else, right? How does this potentially spill over globally?
Right. The big mechanism here, according to several sources, is something called the yen carry trade.
The yen carry trade. Heard that mentioned a lot. Can you break down what that is?
Sure. So the sources describe it like this. For years, because Japan's interest rates were practically zero, investors, big institutions, hedge funds, could borrow money in yen incredibly cheaply.
Okay, borrow cheap yen.
Then they'd take that yen, convert it, and invest it in assets outside Japan that offered much higher returns. Think global stocks, U.S. bonds, maybe real estate, even crypto. One source actually called it a global money glitch.
A money glitch, huh? How much money are we talking about?
Estimates mentioned were huge, trillions of dollars potentially involved over time. One source specifically linked over $1 trillion of U.S. debt holdings by Japanese players to this kind of activity.
So Japan's cheap money wasn't just staying in Japan, it was flowing out, basically funding stuff all over the world.
Pretty much. That outflow helped finance government deficits elsewhere, pumped up asset prices globally, and generally helped keep interest rates lower in places like the U.S. It was a big source of liquidity.
Okay, I see the upside. What's the downside? What's the risk?
The risk is that the whole trade can unwind, and quickly. It only really works smoothly if Japanese interest rates stay super low and the yen stays relatively weak compared to other currencies.
So if rates go up in Japan or the yen gets stronger.
Exactly. Then borrowing yen suddenly becomes more expensive. Or the value of the foreign assets, when converted back to yen, might drop. That can force investors to reverse the trade they have to sell those global assets, buy back yen to repay their loans.
A forced selling of global assets. That sounds like it could cause problems. And the sources say this unwind might already be happening.
Yeah, several sources pointed to the BOJ's first rate hike back in 2024 and some shifts in the yen's value as kicking off this unwind process, maybe continuing into 2025. And they linked this already to some market jitters, flash crashes in Japan, some ripple effects in U.S. stocks, even Bitcoin.
Okay, let's zoom in on the U.S. impact then. How directly could trouble in Japan hit the U.S. economy?
Well, the most direct link mentioned is U.S. government debt. Japan is the biggest foreign owner of U.S. treasuries.
The biggest. How much do they hold?
Over $1 trillion worth,
Yeah.
according to the sources. It's a massive amount.
Wow, over $1 trillion. Okay.
So think about that yen carry trade unwinding. If Japanese investors can now get better returns at home, or if they need to bring money back, they have less reason to buy U.S. treasuries. Sources suggest they've already slowed down buying.
And they might even start selling what they already hold.
That's the bigger concern raised. If Japanese institutions start actively selling their U.S. Treasury holdings, that's a huge chunk of demand disappearing, potentially turning into supply.
And if a major buyer like Japan steps back or starts selling, what happens to U.S. interest rates?
Basic supply and demand, right. Less demand or more supply generally means the price falls, which for bonds means the yield goes up. Higher Treasury yields usually translate into higher borrowing costs across the entire U.S. economy.
So higher mortgage rates, car loans, business borrowing costs.
Pretty much, yeah.
Ah.
It makes everything more expensive, and it puts more pressure on the Federal Reserve, too.
And this is happening when the U.S. already has its own significant debt situation, right?
Exactly. The U.S. debt to GDP is high itself, approaching 100%. And the sources noted the U.S. government is already spending something like $1 trillion a year just on interest payments on that debt.
$1 trillion just for interest.
Yeah. So if U.S. yields rise further, partly because of Japan selling treasuries, that trillion-dollar interest bill gets even bigger. That could really strain the U.S. budget. And sources also mentioned, this is happening while some of the Fed's past tools for adding liquidity might be reaching their limits, plus ongoing debates about the U.S. debt ceiling itself.
Okay, so we've laid out some pretty significant potential risks here coming out of Japan and connecting globally, including to the U.S. But like you said earlier, the point isn't to panic. It's about understanding these things so you can be proactive. So let's shift gears. What about strategies for financial protection? What did the sources suggest?
Absolutely. And the sources framed this really well, I thought. It's not about emergency bunkers. It's about smart financial habits that just become even more important when things feel uncertain, kind of like financial hygiene.
Financial hygiene. I like that. Okay, so what were some of the main pieces of general advice?
A lot of it was getting back to basics, like really nailing down your budget, prioritizing needs over wants, cutting back on non-essential spending, maybe fewer expensive meals out, rethinking big trips just to free up cash flow.
Right, cash gives you options.
Options and flexibility, exactly. Another huge one was tackling debt, especially high-interest debt. Get aggressive about paying that down. One source even suggested a target, like keeping your total debt payments below, say, 35% of your take-home pay. Less debt means lower fixed costs, more breathing room if your income takes a hit.
Makes sense. What about savings, building up cash?
Yeah, building liquidity, having cash on hand, was stressed repeatedly. It gives you peace of mind, for starters. Sources mentioned it's crucial for obvious things like job loss or big unexpected bills. But they also specifically noted its value if, ATMs or payment systems got glitchy in some kind of crisis.
Okay, so cash for emergencies and maybe even if systems hiccup.
And also, cash gives you the ability to potentially invest or buy things if asset prices drop significantly during a downturn. Now, they acknowledged inflation eats away at cash value over time, sure. But in uncertain periods, having that accessible liquidity was seen as incredibly important, potentially more important than chasing small returns. Cash funds were mentioned as one way to keep it accessible, even with low interest.
What about getting professional help?
Definitely recommended, especially if you have significant investments. Talking to a qualified financial advisor who understands your specific situation, your goals, your risk tolerance. They can help you navigate the volatility, maybe find ways to add stability to your portfolio, even if it means accepting lower potential returns for a while.
Okay. One source also talked about skills, right? Not just assets.
Yeah, that was interesting. Focusing on developing valuable skills, especially high-income skills. The idea being that jobs can change, industries can shift, especially in uncertain times. Relying only on your current job might be riskier than having skills that are adaptable and in demand.
And maybe thinking beyond your local job market.
Exactly. Considering how you could offer those skills globally, not just locally, that gives you a kind of geographical diversification for your income. If your local economy struggles, maybe you can still earn from clients or employers elsewhere.
That's a smart way to think about resilience. Any other practical tips for freeing up cash?
A simple one mentioned was just liquidating stuff you don't need. Have a yard sale, sell things online. It generates cash and simplifies your life a bit too.
Good point. And there was a connection made to general preparedness too.
Yeah, one source pointed out that having basic supplies, food, water, medical stuff can actually help your finances in a tough time. If you lost your job, for instance, having those essentials means you don't have to spend your limited cash on basic groceries. You can use that cash for things you absolutely have to pay, like your mortgage or car payment. It preserves cash flow for the unavoidable bills.
Okay, those are all really solid practical principles. Now, the sources also got into specific types of assets that some people are looking at for protection. Let's talk about Bitcoin. How did that come up?
Well, several sources mentioned Bitcoin as something investors are considering as a potential hedge, or maybe an anti-crisis asset was a term used, especially thinking about potential problems in the traditional financial system or with government currencies.
Okay, and what was the argument for Bitcoin playing that kind of role based on the sources?
The argument's really focused on its core features. One, it's decentralized. It runs on this network that isn't controlled by a single bank or government. So the idea is your funds can't be frozen or seized by an institution like money in a bank account potentially could be.
Okay, decentralization. What else?
Scarcity. It has a fixed, limited supply. Only 21 million Bitcoin will ever exist. That's fundamentally different from national currencies, which central banks can, print more of whenever they decide to. And related to that, it exists outside the traditional banking system, outside central bank control. So it's potentially immune to certain kinds of systemic risks or manipulations within that system.
So the argument is it could hold value if people lose confidence in traditional money or assets.
That was definitely part of the rationale presented
Yeah.
as a potential store of value in uncertain times. One source even gave a specific example, a Japanese company called Metaplanet, which apparently announced they're holding Bitcoin on their balance sheet specifically as a hedge. They called the nuclear hedge against the risks they see in Japan's own bond market.
A nuclear hedge.
Wow.
But surely the sources mentioned the downsides too, the risks.
Oh, absolutely. The high volatility of Bitcoin was made very clear. It's not a stable asset day to day.
Yeah.
And how useful it actually is in a crisis depends a lot on how widely it's adopted. Where you live, can you actually use it or access it easily? Diversification was stressed. Any money put into Bitcoin should be seen as speculative and part of a broader diversified strategy given the risks.
Okay, so Bitcoin was one alternative mentioned. What other kinds of assets did the sources point to as potential safe havens or hedges?
Precious metals came up, gold and silver specifically. They're tangible physical assets. They have this long history of being seen as a store of wealth, and they often tend to do better during times of high inflation or recessions or when currencies are losing value.
Gold and silver. Okay, anything else?
Yeah, other things mentioned included defensive stocks.
Yeah.
Companies whose business tends to hold up relatively well even when the economy slows down. Also, certain government bonds, but specifically bonds from countries seen as economically stable, making a clear distinction there from potentially unstable situations like Japan's. And finally, just holding cash, but again, emphasizing cash in stable, well-managed currencies.
Okay, so let's try to wrap this up then. The big picture from the sources seems to be Japan is facing some serious economic headwinds because of its massive debt and its aging, shrinking population.
Big structural challenges.
And the way Japan has managed things, especially with ultra-low interest rates, created this thing called the yen carry trade, which pumped money globally. But now, as that potentially unwinds, it could cause volatility and push interest rates higher around the world, including in the U.S.
That's the potential chain reaction the sources laid out.
Yeah.
Yes, it's complex, potentially worrying, but understanding it is the first step.
And while those global risks are out there, the sources also gave a lot of practical advice, things you can actually do now to make your own financial situation more robust.
Exactly. Things like really tightening up your budget, getting aggressive on paying down debt, building up a solid cash reserve for emergencies and flexibility, and thinking carefully about how your assets are diversified. Maybe considering some of those alternative or tangible assets that were discussed.
Right. It sounds like the core message across the board was about informed preparedness, not panic. Understanding the potential storm clouds allows you to, check your own roof and foundations.
Well put, yeah. It's about empowering yourself with information to make sensible choices. Taking proactive steps now gives you more resilience, more options, no matter how these big global economic currents shift.
So maybe a final thought to leave people with, drawing from all this, is what we're seeing in Japan, this struggle to balance huge debts with difficult demographics. Is that maybe a preview? A glimpse of challenges that other developed countries, maybe even the U.S., could face down the road as their own populations age and debts grow?
That's a really sobering question raised by the material, isn't it? And maybe tied to that, what does this growing interest in assets outside the traditional government-controlled financial system, like Bitcoin or gold, actually tell us about people's long-term trust in those traditional systems and currencies? Something to definitely keep thinking about.